Hey guys, welcome back. Jeb Smith, Coldwell Banker Realty, and Josh Lewis of Buywise Mortgage doing our final live of the year, where we're basically here to answer any questions you have about the housing market, whether it's buying a house, selling a house, interest rate, loan programs, whatever it is related to housing. You know, we sit here. Actually, we do this live to allow you guys to ask questions live, and we can answer them live, and you can get some feedback immediately versus having to wait or watch a lot of videos on YouTube. So we thank you guys for being here. If you're here now, and let us know how the audio is. Earlier today, the audio was a little bit low, so let me know how everything sounds, and also where you're tuning in from. If you're watching from across the country, we always love to see where you guys are. But again, I'll start with Josh. Usually we start these meetings by talking about interest rates, because a lot of you guys want to know where things are going, where we're headed into the new year. And we've talked about this a lot, but we'll just kind of throw it over to Josh and see where we are on interest rates and see where it goes from there. But if you have questions, put them in the comment box there, because that's going to kind of dictate where we go from here.
All righty. If I remember correctly, the last one we did here, an update, was probably about 2 weeks ago. Right. And really almost nothing has changed. For the whole month of December, we've been in a very narrow range of best rates of all time. We love every week the headline comes out that rates hit an all-time low, but they moved 0.003%. So all month of December, we've been at an all-time low in terms of mortgage rates, whether it's Fannie Mae, Freddie Mac, FHA, VA, and jumbo stuff. Obviously, everything is low. So the most common interest rate for a 0-point loan on a Fannie Mae, Freddie Mac conforming loan is in about that 2.75 range. For super well qualified borrowers, you might be able to get it down to 2.625. Borrowers with higher loan to value, slightly lower credit score might be as high as 2.875, 2.99. But anyone with a good credit score is getting a rate under 3% right now. On the FHA and VA stuff, the numbers are just insane. Well, probably the most common rate we're locking right now is about 2.25. As you've pointed out on the show before, you can get rates down in the ones, a 1.99, a 1.875 on a 30-year fixed on the government loans. You're paying for it, but I talked to a guy this morning, very well qualified, 50% loan to value, 800 credit scores, and it was only a 1.25 to get 1.875 on a 15-year fixed for just a standard conforming loan. So they're out there. They're numbers that you just kind of shake your head when you first see them, because we're just not used to rates anywhere near that low. I remember in 2013, the first time I did a 15-year under 3%, I had the same feeling, like 2.875 on a 15-year. Everyone should do this. So the numbers are there. They're really, really, really low. Anyone who hasn't refinanced within the last 6 months should. We have a lot of clients that did close first part of the summer, in really good rates, low threes. But we use a rule of thumb. People always ask, they'll say things like, well, I hear you shouldn't do a loan unless you can save 1%. That was a real common theme, or a real common rule of thumb that people like to throw around back in the 80s and early 90s. But the thing we have to remember is most loans were $85,000, $110,000 at that time. So it doesn't account for the large size of the loans that we have right now. So when someone asks, how much do I need to save on my interest rate to make it make sense to do? Take $125,000 and divide it by your loan amount, and that's going to tell you how much you need to save. So I talked to a friend of mine in Chicago this morning. She has a $125,000 loan. So take $125,000, divide it by $125,000. She needs to save a full percent to make it make sense. So she's in the very high threes. It makes sense, just enough to savings there to do it. Now go to the flip side. You have $1 million loan. 125,000 divided by $1 million, you only need to save 0.125% in interest to make it make sense over the life of the loan. So our average loan about $420,000. So when you look at it that way, for that person, somewhere between 3/8 and 0.5% in interest. So if you did a loan right after COVID broke out at 3.25 and you get down to 2.75, 2.625 right now, as crazy as it sounds, it can absolutely make sense, and especially when you look at those numbers over the life of the loan.
Absolutely insane. I mean, I remember when we were talking about loans in the 4% range and people were refinancing, and we were thought you'll never see anything lower than this. And then the threes. And then we said the same thing. Now it's in the twos and getting down in the low twos. I mean, it's incredible where things are going, man.
And go back to what we were saying when COVID first broke out. A lot of lenders were pushing out flyers or running ads saying, hey, all-time low rates, pay a couple points, and then you can get a really low rate like 2.99 on your 30-year fixed. Those people that paid 1.5 or 2 points in March are pretty pissed right now that they did that.
100%.
That's why we've always said pay as little for your loan as possible, because we are in a 40-year bull market in interest rates. They have not stopped going down. Until they do stop going down, I'm not going to suggest that anyone pay points for a loan. You know, in 2018, when rates got really high, and relative to where we are right now, they are really high. I was almost facetiously saying really high. They're 4.75, 4.875 for low credit scores at 5%. We had some people promoting a 2-1 buy down. Go to a seller and say, hey, give me a couple points and I'm going to buy my rate down so I can get into this property and qualify. And again, everyone that was doing that looks pretty foolish. There are pretty obvious technical charts and trends that you can see over time that until those support levels break, support levels going all the way back to 1982, until those break, we are in an improving interest rate market. They don't go straight down. They may increase for a month or 6 months or 2 years at a time, but over the long haul, they're decreasing and they will continue to decrease. So big story is don't pay a bunch of money for your loan. Do a 0 point, do a no cost loan, and be in a position that when rates drop, whether it's 1 year or 5 years from now, you can continue to roll down with the market, especially if you're in a larger loan.
No, absolutely. And not to pat ourselves on the back, but honestly, we've been saying that for 7 months on videos of doing this. So, and it just seems to become more and more clear that people shouldn't be doing that. So, solid advice coming from your side there. So you brought up something that I thought was, worth talking about there. You said, you know, that people shouldn't be paying money basically for their loans, right? In a market where rates continue to go down. So you hear a lot of people out there talking about no closing cost loans or, you know, not paying anything for your loan, but you're always going to have costs associated with your loan, right? You might not have closing costs, but, and that's what most people think when somebody says you're going to get a loan, no closing costs. They think there are no fees attached to it. And when they get it, you know, when they get the fees, they think, well, you told me there was no closing cost. So why don't you explain a minute about what closing costs are, and typically what's covered when you say no closing costs, and then what people should be expected to pay when they do that sort of refinance and there is no closing costs involved.
So one of the things a little bit frustrating, after the meltdown, the government came back and said, hey, this whole disclosure process we have of good faith estimates, it doesn't work for borrowers. There's no teeth to the laws. So a good faith estimate, it's basically some people are trying to educate their clients and give them accurate answers. Some people are lying and giving incorrect answers. Right. So now we have new forms. At the beginning of the process, you get a loan estimate, and there are tolerances that cannot vary to the closing when you get your closing disclosure. So that piece is really good. I love that everyone has to give you an accurate loan estimate at the beginning, and they're held to tolerances on those figures at the end of the closing disclosure. The closing disclosure doesn't do a great job of differentiating between closing costs and prepaid items. So closing costs are things that, as a homeowner, if you refinance, you're going to incur these costs. If you don't refinance, you're not going to have them. An appraisal, a credit report, an escrow or a settlement fee, title insurance, a recording fee. You don't refi, you don't have those fees. Those are the costs of doing the loan. Right. Now, we always have ways of covering them. You're going to pay it one way or the other. What we're suggesting is you pay it by taking a rate other than the absolute rock bottom lowest interest rate. We're seeing probably on about 65% of our conventional loans appraisal waivers right now. So our total closing costs on a loan with a waiver, unless you get to a really big loan, is about $1,600. So $1,600, let's say you have a $320,000 loan. That's a half of a point. So in general, if the rate is 2.75 for your qualifications, we can do a 2.875 rate and charge you nothing. We're not adding anything to your loan amount. We're just giving you your current loan at a lower interest rate. So people will often say, well, what in the heck? You said I'm not paying anything. You're covering all my closing costs. What are these additional costs? And it's because their loan officer didn't explain to them that there's always going to be prepaid items that you paid at closing. These are costs of homeownership. They're going to be there whether you refinance or not. They're always there. You're always going to pay your homeowner's insurance. You're going to pay your property taxes, and you're going to pay interest on the loan that you have. So on the new loan, you're paying some prepaid interest. If you're impounding, you're going to prepay some taxes, and you're going to prepay some of your insurance to establish the impound account. So when they come due, there's money there to pay it. So we can add that to the loan amount. We can have you bring it in at closing. Now in California, for the most part, the way we structure loans is for you, you're going to skip 1 month of payment. So let's say if we take your loan application today and we're going to close on the 25th of January, you're not going to make a payment on your new loan until March 1st. And the reason for that is the new lender doesn't want a partial payment. They don't want 5 days of interest due on the 1st of February. So they collect 5 days at closing. Your current lender says, hey, you had that loan for 25 days. They're going to have that. So you're going to have about 30 days of prepaid interest always at close of escrow. So we need to account for those. But normally, when we pencil this out, you can show people that if you bring in your normal monthly payment at closing, it generally balances out to establish those impound accounts, and you're not adding anything to your loan amount. You're not out of pocket for anything that you wouldn't normally have paid. And it's a good balance. But we always go through those numbers, give people an option. Do you want to add it into the loan, which sets you back a little bit because you're growing your loan, but it can put some money in your pocket during the holidays. You can skip that payment. You can skip 2 payments. You know, a lot of times you hear the call centers are really big on, hey, we're going to help you skip 2 payments. Right. You're not skipping 2 payments. You're prepaying 60 days of interest through escrow instead of 30 days of interest. So it's still there. You're just adding it into your loan amount. So make sure you're working with a pro who can walk through those numbers and show you each option and what they look like. And depending on where you're at and what's most important to you. I have a couple clients right now. They're like, give me the biggest loan you can. Help me skip the 2 payments. Give me back the refunds I'm going to get from my current impound account. And for them, it makes sense. One of my borrowers is doing a bunch of work on the outside of their house. They don't have all the cash for it. So they're, without doing a cash out refi, they're just getting some cash out of there. But that's the important part of knowing what closing costs are, knowing what prepaids are, and your options for coming up with them without adding them into your loan amount.
No, really good explanation there, Josh. It comes up quite often, and I think that's pretty clear and concise in explaining it. So we're starting to get some questions coming in here. So I'm going to throw those up, and then we can come back to that if we want. The first one's coming from Prince Boateng, asking about inventory in the early months of 2021. My take on this is that it's probably, typically what we see is kind of a seasonal effect with inventory, right? As you move into what we call the winter season here in our market, the fall winter market or what have you, you start to see inventory decline, towards the beginning of November, and it continues to decline through the end of the year. And then you start to see it pick up sometime around Super Bowl is what normally, so that's the first weekend in February. I personally think you're going to see a delay in that this year. Now this is, my crystal ball is as foggy as anyone else's. And it's, so this isn't, in stone by any means, but I think you're going to see a delay in inventory. And the reason I think that is because, here in Southern California, at least, the numbers right now with the pandemic are as high as they've ever been. ICUs are full, so on and so forth. We're on a lockdown. All of that stuff is going on. So I think, for our market, at least, you've got people that aren't going to put their homes on the market until there's some clarity with what is going to happen with the vaccine rolling out and all of that. So I think it's going to be a couple weeks to potentially, maybe March or so before you start to see inventory really come on the market. In other areas of the country, you might see it sooner, but you also have to remember in other areas of the country where there's snow and there's all of these other weather elements playing along, that can also be a factor in how inventory plays out. So I just think because of the pandemic going on and shutdowns and unemployment and all of that, there's probably going to be a little bit of delay in inventory coming on. But I do believe when it comes on, buyer demand is going to be there because interest rates are going to remain low, and you're going to have a really, really strong spring market. Anything to add to that, Josh?
No, some people are talking about, we saw the housing numbers today. Home sales were down slightly, and it's like the 3rd consecutive month, and that's purely an inventory issue. Plenty of buyers willing to buy a lot more homes than what we're seeing in terms of the volume, just very low inventory. So you see the seasonality. Inventory is going to creep up at the first part of the year, but you're probably right, not in the levels we've seen in the past. And the biggest issue, there's a lot more willing and able demand to absorb that inventory as it comes on the market. So I don't think we're going to see any change in the dynamics. When a buyer really asks, is there going to be more inventory? Yeah, they would like to have more homes to choose from, but they're really asking, is that supply-demand dynamic going to change where I have a little bit more leverage against sellers, and I don't see anything changing on the horizon for that.
No, and with that said, I mean, I've been talking about this for 2 months now that you're going to see before the numbers ever started to shift to a negative, versus expectations. I've been saying, hey, look, these numbers are going to change because inventory levels are going to decline because it's just a seasonality thing. It's what happens year in and year out, less inventory during this time of the year. In addition to the pandemic, the virus out there, you just got less people wanting people to walk through their homes. You don't people are just they're unsure of this whole thing. So you take all of that, less property out there, buyers can't buy property that's not there. So, I told you were going to see a decline in pending home sales and existing home sales, and you did. You're probably going to see that for, the next couple, maybe the next report as well in January. But I think as you move into March and April, new home sales are going to pick up, existing, pending, all of that's going to pick up, and the housing market's going to prove to be pretty strong in 2021. So Natalie is asking, what does it mean if they say you can lock in at 2.75 interest rate with 0 points? So we kind of touched on that a minute ago, but if you just want to answer it.
Yeah, Jeff, the best example I give to people is, people always ask, what's the interest rate? There's not an interest rate. There's 20 interest rates available on any given day. 2.75 with 0 points means that is the par rate. It means the rate that a lender wants to lend you at without charging you points and without giving you any credit back at closing. You can get a lower interest rate, but you're going to pay a fraction of points or multiple points to get it, or you can take a higher rate and the lender will actually take you to pay a higher rate because they're going to realize more over the life of the loan and interest. You can use that to cover your closing costs. So what the lender is telling you is, with your down payment, your qualifications, today with 0 points, 2.75 is the rate that you can lock in at.
Got it. All right. So Sear Guru, California is trying to extend the moratorium till the end of 2021. Yeah. I mean, I haven't seen that piece of news particularly, but California is going to be on the extreme end of the moratorium, like New York probably. I mean, those two markets are going to push it out a lot further than others, if I had to guess. So Larry's asking about getting a HELOC in 2021. Should you sell or get a HELOC? It's two ends of the spectrum, in my opinion. So depends. I mean, should you sell would be, a completely different question than should you get a HELOC.
And there's two questions there. If you sell, should I sell and do what? Sell and rent, sell and buy another property? There's a lot there, and it's hard in this context to see the full question.
But, HELOCs are one of those things, depending on where your rate is at the moment. A lot of times in this market, because of where interest rates have gone, HELOCs are it's almost better to do a true loan. I mean, like a refinance and encompass that $20,000 that you owe on your $200,000 loan, along with whatever money you're trying to pull out, and take one low fixed rate versus a potential adjustable rate or something on a HELOC. So you could probably touch on that though, Josh.
I'm not a fan of HELOCs for a number of reasons. A couple of them you just pointed out. If you can borrow under 3% and the HELOC's at 4 or 4.5%, and you're seeing teaser rates. When we go back to the boom of HELOCs between 2000 and 2005, you were getting prime rate -1%, prime -1.5% for the best qualified borrowers. Now they do that again, but it's only a teaser for the first 6 or 12 months. And when you look at the underlying interest rate, it's at least 1% higher than what you can get on a 30-year fixed right now. So it's a higher interest rate. It's a variable interest rate that, if and when interest rates increase in the future, is going to go higher. And then on top of that, people look at it saying, hey, what's the benefit of a HELOC? Well, I can lock in my ability to access equity without having to pay for it until I need it. So it's sort of there as a safety net. Well, we saw in 2008, 2009, 2010, it's not much of a safety net. People got their HELOCs reduced, frozen, locked, closed. So you don't have the agreement with a HELOC that says I have a guaranteed right to borrow this money in the future. You might have the right to borrow it in the future. So if we're looking at just accessing some of our equity for a safety net or for other investments, I would look closely at just taking the money out in a refinance. And if you're seriously thinking about selling, it's a bigger and deeper discussion. Sell and do what? Are we looking at renting and thinking that we're going to buy in at a lower point? I don't think so, but it may be buy and sell and buy another property. So lots of questions there with that one.
Excuse me. All right. Coming back, guys. Sorry. I think you might have to talk here.
No worries. I got it. So let's jump here at LC. You can go back to a couple of Hi, should I be talking to my lender or my processor? The processor has now reached out to us to get paperwork. We're supposed to close next week. Your loan officer is responsible for working with you to determine your qualifications, to help you select a program and getting the thing on track. Once it's in process, there's going to be some updates and some things that are needed throughout the process. So totally normal that the processor would be reaching out to you for those things. If you have questions or something's unclear, your loan officer should be available for you, but totally normal and to be expected for you to work with the processor throughout the loan process. If you're looking at closing next week, I would definitely, if they're needing items, work with them and work with them with some urgency to get that stuff so you don't have any delays or problems or issues at closing.
No, good. And I'm back, I think. So, all right. So we got someone watching from Houston, first time home buyer, self-employed, $45,000 saved, looking at a new build, just needed to restructure salary on W-2 to show income. Okay. So just more of a comment there. Al is asking, how long of a lease back can you do on an owner occupied loan? So I believe it's 60 days, Josh. Is that right?
Yeah. So with any owner occupied loan, you're signing an occupancy affidavit that says you intend to occupy the home within 60 days of closing. So any lease back beyond that the lender is aware of makes it ineligible for sale to Fannie Mae, Freddie Mac, FHA, VA. It would be naive to think that people don't negotiate things separately outside of escrow. So it happens, but in terms of what can be shown on paper through closing and you getting the lease back credit through closing, 60 days is what you're looking at.
All right. So Cameron is asking, what are options after FHA pandemic forbearance for repayment? So I'm thinking he's asking that he took forbearance with an FHA loan. His loan is being reinstated, maybe asking what his options are or asking, he's asking for what his options are. So with FHA, you have 4 options, just like you do with conventional. And that's essentially with FHA, it's a little bit different. Instead of a deferment, it's called a partial claim, where they take that money, make it a silent second loan, and you pay it off either when you refinance or sell the property. And that's probably the best option, the option that most people want. And then they have the other options, just like every other lender, which is some sort of repayment option or a loan modification option, or if you wanted the lump sum option. Anything I'm missing there, Josh?
No, you've been all over that, and we've been so busy just with the volume of refinances that you're going to be the expert on that one and covered it.
Yeah, and the thing to keep in mind, and I just did a video on this, that a lot of people, there's a lot of YouTubers out there, there's a lot of people out there saying, hey, look, they're giving you 12 months of free. You should take it. You should take it and you should put that money into investments. You should put it in your savings. You should do something with it. And the reality is, not everyone is going to qualify for a partial claim. Not everyone is going to qualify for a deferment. You have to document. My understanding is you have to be able to document your income to the bank to show them that you're able to continue making that payment. So if you're able to, that's one thing. But if you're not able to, and you think that just taking that money and putting it somewhere is going to reap some big benefit in the long run, there might be some sort of repayment option that you have to do that could negatively affect you. So just, don't think that it's just free money out there, because.
And look, Jeb, at what happened with the PPP. It was rolled out super quickly.
Absolutely.
Pandemic is hitting. Government has to do something, and they said, hey, we're not going to ask any questions. We're going to throw this out there. And now you see the second round of PPP, much more significant restrictions on it. So every time you see this extension of timelines on forbearance, foreclosure moratoriums, the government has had more time to think this through. They've got input from industry groups that there's no free ride. Even when we say, hey, we're going to do an eviction moratorium, and that's good. We don't want people bounced out in the street, but you can't do that without also giving relief to landlords, because most landlords don't own their home free and clear. So they have a payment on that. And you're saying, hey, you can't collect your rent and you can't kick the people out. So there's just a whole cascade of this. And now that we're 8-9 months into this, the government is seeing, okay, we really have to think this through and what there is. And it wasn't meant to be a free ride for people who can otherwise afford to make their payment. So by all means, if you've been affected by the downturn and you need forbearance and you need 12 months, take advantage of everything the government is doing to help people who need it through this process. If you think you're going to leverage it and play a game where you're going to get ahead because of the forbearance, I really don't see it happening as a recipe for disaster for people that are trying to play that angle.
No, absolutely. And if you have FHA, you have until the end of February, if you haven't already, to take that. And actually with conventional, as of now, it expires tomorrow. So you have until tomorrow to request it. Outside of, they probably will extend it if I had to guess, but as of now, it hasn't been extended. So unless you have a multifamily property. Al is asking another question here. Do married couples who file tax returns jointly need to both be on the loan? I'm a W-2 with great income. My wife is 1099, but shows a small loss. So I'll let you take that. Pretty easy one.
Perfect. Yeah. So on a conventional loan, zero reason why your wife needs to be on there. She can be. It sounds like you probably qualify even with her 1099 loss. So she can be on title. She can be an owner without being on the loan. You qualify. You're the only borrower. She's going to sign the deed of trust as an owner to the home, but not qualifying on the loan. Your follow-up question was any landmines to consider. If for any reason you were doing FHA or VA financing in a community property state, such as California, the only landmine there is they would have to pull credit on both of you. Even if she's not on the loan and we're not counting any negative income, we would count her debts against you if there were any separate. But again, going back to your comment on the income, I don't think it's an issue for you. So it sounds like whatever type of financing, have her be title only so she can be an owner with you, and then you're the only borrower and the only person obligated on the loan.
All right. Sabrina's asking, first-time home buyer, 2-year post-bankruptcy in June, looking for an FHA loan. Credit is good, working on DTI. Should I be putting more than 3.5% down on an FHA loan? So a lot of you have been asking recently about buying a property, more so FHA after bankruptcy, but some people saying conventional after bankruptcy. And Joshua and I actually were going to lead into this as one of our first things to talk about here today was bankruptcy after we're buying using FHA after bankruptcy. So anything you want to say on that, Josh?
No, other than, so with FHA, there is no benefit other than the smaller payment from a smaller loan in putting a larger down. And someone listening may go, well, wait, if you put 5% or more down, the mortgage insurance is reduced, but it goes from 0.85 to 0.80. So the benefit is so negligible that I would much rather see a borrower with larger reserves at closing than with a slightly larger down payment. It's a personal thing. If we're talking about a much larger down payment and it's 10% and it makes a difference in the monthly payment, and that's where your comfort level is, by all means do that. But especially 2 years post bankruptcy, I think the reserves are really important. I don't want to see a borrower go into a home with no post-closing reserves. Now, FHA will let you do it. Doesn't mean it's the smartest thing to do. So I'd rather do the 3.5% down and have you with $2,000 or $5,000 or $10,000 post-closing reserves.
No, good stuff. I happened to skip one here by accident. Elizabeth's asking about Biden's $15,000 for first-time homebuyers program, asking if it's going to be available in 2021. So my understanding is that is just, part of his running for office, right? Something that he wanted to do. There's no guarantees that that's actually going to happen. And keep in mind, it's going to have to be signed off and agreed upon in order for that to even take place. It's a good idea, and to stimulate more housing. I'm
willing to debate you on that.
Well,
one,
it's going to create other issues, is what it's going to do. But it's unclear of exactly how it's going to work out, to be completely honest. So at this point, I wouldn't be counting on it. If you were thinking about buying a house, if that was, if you were waiting on that to happen to buy, you might be waiting a little bit, but there's a chance it could happen. So. But again, it's going to basically all it is my understanding is that if they do give you a tax credit, it's essentially coming out of what you would normally receive in your refund. So it's not a true credit the way I read it, but that might be wrong. So as we get more information, we'll put it out there though. Are there lenders who can close in 14 to 18 days? If so, would it have to be conventional? So Josh can answer it, but yeah, I mean, there's lenders out there that can close in less than 20 days. Typically conventional, I think, not as common as lenders that can close in 30, but it can happen.
And here's the thing that I always like to point out to people when they're asking questions like this. The borrower is at least 50% of that equation. Most lenders can't close in that time frame. We're a broker, so we work with like 30 different lenders. I have a handful that could absolutely knock a deal out in 14 to 18 days. But the conversation we're going to have with the borrower is you have to be on it. We send out disclosures. They have to be signed and back to us immediately. We need an updated pay stub. We have to have it. There's not a lot of time to waste just with the moving parts. The way the disclosure regime goes right now of what we're required for compliance, the fastest you can close is 8 days. So if we're talking 14 days, we only have 4 more business days in there. So everything has to go perfectly for a well-qualified borrower, especially if you get an appraisal waiver. The wild card would be in there, depending on what part of the country you're in. Appraisals can take 2-3 weeks just to get the appraisal right now. So you could have an approved loan sitting there waiting, ready to go, and needing that appraisal to come in. So those would be the pieces that we're looking at.
And I'll add to that and say that, even if you can find a lender that can close in 18 days, 14 days, whatever it is, a lot of times escrow can't even keep up with that time frame, depending on the state. Like in California, I believe you're in California because I remember you've commented before, but it's hard for escrow to even keep up with those timeframes these days, just because they're always waiting on other parties to do certain things, fill out escrow documents, so on and so forth. So you need, like Josh said, everybody has to be on the ball in order to make those timelines work. So
jump down to his follow-up question there. I don't want to leave everything here with him. Are we seeing deposit banks like Chase and Wells? Chase and Wells are dinosaurs, and they will take forever to close your loan. 100%. So if you want to be anywhere near 21 to 30 days, go with anyone but Chase or Wells. And I would question what the benefit is. For high net worth individuals that have large accounts and are private banking clients with them, they can get excellent terms. Anyone other than that is going to get better terms, better service, faster turn times anywhere other than a large depository bank.
Got it. All right. So we'll go back up here. Caesar's asking, or currently lives in Miami, planning to purchase a single family home in March. Is city rehabilitation housing programs a good idea to fix a home? Here in Southern California, I mean, there are programs out there. A lot of them have no money, to even do this sort of thing. So I can't even comment on that. I wouldn't be a good measure of whether it's a good idea or not. I mean, if the city can do it and you can make it work, sure. If the city's willing to give you money to buy something and fix it up and give you a tax break or what have you, absolutely. But in most markets that are moving like they are right now with low inventory, high buyer demand, I think you'll probably see less of that. But again, not 100% sure on that one.
In California, almost all of our programs that are available, people have the thought or hope or expectation that it's free money, and there are so many strings attached, either making it impossible or difficult to qualify, or repayment recapture. That's really the only thing that I would say is pay close attention to the details. It can be a good option. I know other states, other areas do have options that work well. So just read the fine print and be aware of what you're getting into.
Cool. All right. His wife and he are in the middle of buying a home. The seller's requested an extended closing date to search for another property to relocate. What questions should I ask before moving forward? So you should just get a time frame on it. Contingencies in this market are, I'm assuming there's, I don't know if there's a contingency on this one or not. If there is a contingency for them to buy in order for you to be able to purchase the home, the option, you don't really have an option other than finding another property if you want to buy that property, because they can hold that contingency out there forever. If there is no contingency and they're just asking for additional time to find a property so they're not homeless or searching in the midst of after selling a property, I would just nail down a time frame and stick to it. I mean, especially if you want to close on your loan, I mean, you have to deal with rate locks and all of that stuff on your end. So you need some sort of timeline as well. So, nothing other than figuring out a timeline that you both can agree agree on, and allowing it to close. Your other option is to close and allow them to rent back, right? So you could do, you could close on the property. That way you can secure your loan, secure your interest rate, and then you could give them up to 60 days or 30 days or whatever it is to find a property. And that way it puts pressure on them while they're paying your mortgage and rent to find a property. And then there's some sort of deadline. Anything we're missing there, Josh?
No, there's a lot of moving parts, but for the most part, we see it's pretty common in this market. Sellers want to sell, but they also don't want to leave themselves homeless or unable to find something. And in most situations, both buyers and sellers, it's a tight market, and we've seen them cooperating and working together. Everyone knows what each other's needs are. Just communicate and see if there's a middle ground solution that works for both of you.
Right. So Al's asking one more question. I'm just going to be really quick with this one here, and then we're going to move on. Which lenders tend to have the best terms of closing and closing on time? I would say talk to a broker, right? I mean, talk to Josh, talk to somebody that has access to brokers. They typically tend to close loans faster, have the best rate and fees. And so I would stay away from the big guys.
Here's an answer to this. You just asked about big banks, and now you're just asking name lenders. The lender is far less important than the loan officer that you're working with. I'm a broker. I'm biased. I think brokers are fantastic. Jeb and I have several good buddies that are also in this business, and they work for direct lenders. Chris Finoglio, buddy from the club, is a great lender. I would worry more about getting connected with an expert than I would picking a name brand lender. Everyone should be within a range. Get a referral or recommendation from your realtor, from a friend. Talk to a couple. See who you're most comfortable with, and ask them, how many deals did they close last month? How many were purchases? What was the average length of the escrow?
No, 100%. Yeah, 100%. Barry, first-time home buyer, probability would be selling 10 to 12 years' time and moving back to Ireland. Am I buying at the very top of the market, open to a big loss when rates rise? Hard to say. I would think if your time horizon's 10 years, here's the deal. I don't think you're buying at the top of the market. That's one. But secondly, my go-to answer for this question, should I buy now? Should I wait? Whatever is, if you're comfortable with the payment, you're not stretching yourself, and you're going to be in the property for 5+ years, you're probably going to be okay, right? I mean, as we know, real estate long-term, it is going to be a winner. So 10 years out, when have you ever seen, look at markets, right? I mean, even the last downturn that we went through in 2008, 12 years later, 2020, look at where home prices are. So, we went through the worst housing crisis we've seen in 2008, and now we're back 25% above those prices in some markets. So, I don't think, I think you're probably fine buying now, especially with that time horizon, but your guess is as good as mine in the long run.
And that was exactly what I was going to say, Jeb. If you had the most spectacularly bad timing in the history of man, and you bought at the absolute highest day before the mother of all downturns in 2007 and held to today, 2020, you made money on that property, and you paid the mortgage down for the last 12 years. You'd be sitting on a chunk of equity. Neither of us think that big downturn is coming anytime soon. And we don't think that now is the peak. So if it makes sense for you to own and you have a 10 to 12 year time horizon, you should be absolutely fine.
All right. Jay-Z's on there. Damn, dude. Desperately in need to get a car. How soon after closing can I go finance one? After your loan closes, do whatever you want.
As soon as it's recorded, they hand you the keys, head to the dealership.
Yeah. Just don't do it before the loan closes, because they will find out. So, there's no issues there. After the close of escrow, though, don't do it before. So we're going back. I don't know where that one's going. So what's an average mortgage rate? I know this pandemic has brought the interest rate at the lowest in history. So I think the average I saw the other day that Freddie Mac had posted was like 2.83. So that takes into account, everything. And the average was 2.83. If you want to comment on that, Josh, go for it.
Yeah, well below 3%. And those numbers that you see, the most commonly cited figure every Thursday, Freddie Mac publishes the primary mortgage market survey, the loans they purchased in the last 7 days. And it also includes a certain amount of points. It's usually anywhere from 0.3 to 0.7 points people are paying to get that average rate. And it was well below 3% last week.
All right. Cameron is asking, talk about PMI on FHA loan. I'm paying $150 monthly. Is that supposed to help me in times like this And at what point on an FHA loan can PMI be removed? So, I mean, I can talk and then Josh can jump in here. PMI is not to help you. PMI is there to help the lender in case of default. So you pay that PMI because you're a higher risk in theory to the lender. If you default on the loan, they get repaid. That's why that PMI is there. So it doesn't benefit anyone in this market other than the lender. And at what point can it be removed on FHA? Unless you put at least 10% down, it will never be removed. If you put 10% down, then I think it's removed in the 11th year. Is that right?
And at a percentage of the original loan balance, longer than anyone keeps an FHA loan for the most part. And what I would say, anytime someone asks, well, what does PMI do for me? It enables lenders to make loans they wouldn't otherwise make. So the one and only benefit for you is to get in with a much lower down payment than lenders would require, were there no such thing as mortgage insurance.
All right. Al saying thanks for tuning in there, Al. Appreciate the questions. Let's see here. What do we got? So Moonlight Sunrise. Should I wait to buy a new construction home in Charlotte, or shall get into contract in February 2021? Tough question. Don't know the Charlotte market that well. I am from North Carolina, but it's like any other market. You've got to do what's right for you. My guess is new construction is probably going to continue to thrive. I realize that the numbers that just came out were a little disappointing with regards to expectations. It was down 11%. But if you go back and look at what new construction has done for the last 6 months, they've exceeded expectations like considerably every single month. It's just kind of normalizing back to the trend of where it should be. So my guess is you're going to start to see those numbers, improve and probably exceed expectations as the market comes back around. Inventory continues to stay tight, buyer demand picks up. So hard to say, but what I would say is in Charlotte, there's a season there, right? So that there's snow occasionally, you have a winter. As things start to heat up, more people start to come out and do their thing, you're probably going to see that market pick up. So I would tell you, if you were going to buy in new construction, maybe you buy when less people are looking at it. Especially if it's in an early phase of a development, right? If you're buying new construction, you always, in theory, want to be one of the first in there, if at all possible, because so you can reap the rewards of the building out of the development. Not to say that you can't be the last one in, because that still works too. But in theory, the earlier in, the better off you are. Anything you want to add to that?
No, other than interest rates are going to stay low. The market's going to be strong this year. So if we're talking about waiting 2, 3, 6 months, I don't see any benefit. It's not like rates are going to move significantly lower, and prices will continue to inch up. So it's not an end of the world life or death decision, but sooner rather than later in a market like this. And
they're saying they're also willing to live for 6 to 8 years. I suggest you live longer than 6 to 8 years. That is not a lot of time. It'll be here before you know it. No. I mean, if you're going to live in the property for 6 to 8 years, 5% down, Charlotte's a good market. I mean, it's grown out considerably over the last 15, 20 years and will continue to do so. I mean, it's, North Carolina is one of those markets that a lot of people are moving to out of high cost areas like California, and New York. And, it's got 4 seasons. It's offers a lot, so it will continue to be one of those markets that people move to. We got one more here. We're pushing 45 minutes, so let me know how your time stands, Josh. But townhome new build for high 680 in Anaheim. They didn't disclose prices on Mandate Solar marked up price until after signing. They don't want to refund me on my deposit. Any advice? So first off, I don't know if you have a real estate agent, right? That's one thing when buying new construction. Even if you buy new construction, you should have a real estate agent outside of the builder, outside of the developer of that property, because of things like this, right? So that you can go through the paperwork, make sure somebody's dotting the I's, crossing the T's. Builders don't do all of that. They're not in the business of hand holding and walking people through the process. They're in the business of selling homes. And so, my guess is if that wasn't disclosed, chances are you probably have, you have the ability to back out. But if you have a real estate agent, they should be able to walk you through that, right? It's hard for me to give you advice on something like this because you're in contract and I can't really pass along advice. But I would think that you have something that you could do there.
Let me throw this in there, Jeb, to kind of piggyback on you saying that even if you're buying new construction, you should have realtor representation. In California, the standard California Association of Realtors purchase agreement is 10 pages. Most states are very similar, somewhere between 8 and 15 pages. If you walk into a sales office and buy new construction, you're looking at somewhere between 100 and 150 page contract. If you think the extra 100 pages are for your benefit, you would not be correct. It's 100 pages of legalese to cover their butt and lock you in as much as possible. So Mario, it's not to say that you don't have an out here. I would hazard a guess that you probably do, but it's buried somewhere in the 100 pages, and you're probably going to have to get legal help to address that. But just try to work with them and see if you can come to an agreement. It's one of those situations where they have lawyers on staff. It will cost you more to get a lawyer than it will than the amount of your deposit. So try and work with them amicably. Point out that you're unable to cover the cost of the solar that wasn't disclosed. It's a strong market. If they've been building for a while, there's a very good chance they can sell it for more than what you're under contract for. So there should be something there that works to everyone's benefit.
All right. Going to go a couple more questions here as we close this thing out. Do lenders prefer new construction over existing homes, similar to car loans, or they prefer to finance new cars with warranties over used cars? No, but Josh, you can jump on that.
Zero concern whatsoever. Terms don't differ. Underwriting guidelines don't differ. They're going to make sure that it's a safe and sound home, and the value is supported by the market. It's really all that lenders care about.
Awesome. So pushing 45 minutes here. Anything else you want to add to this, Josh, here? Just kind of scrolling through some of these.
No, you're going to throw up our contact info. And for Al Bundy here, give us a call. Jeb's going to throw up our info. You have some specific questions, and I have some specific advice for you there, but don't want to bog down everything here with everyone. So yeah, shoot us an email, get back to you and get you some answers on that. It's important questions, but don't want to drag on too long here and not answer other folks.
Yeah. And one of the things that we've always said too, with this whole thing is that if you are out of state, out of California, because we're in Southern California, if you're in Southern California, we're both easy to contact, right? Emails there. Even if you're not, reach out to us. If you're looking for a lender, somebody in your market that can help guide you through the process, that does business like Josh does business. He networks with like-minded individuals. He can guide you in the right direction and put you in touch with someone. I probably get 20 people a week, Josh, reaching out to me to do this sort of thing. And we're putting them in contact with people all across the United States. Same with lenders. I mean, with real estate agents, if you are looking to purchase a home and you don't have someone that you trust, that you know, who does a good job, reach out to me. I've done a lot of that legwork. I network with a lot of these people, and I'm happy to put you in touch with somebody who can guide you in the right direction, and take good care of you. So happy New Year, guys. We appreciate you tuning in. My goal with this whole thing is going to be to do one of these per week in 2021. So you're going to see a lot of my face. So get your questions ready. But if you're watching this later, put your questions below. Josh, any parting words?
No, I was going to speak for the audience and say they might want us to go masked singer style and have to wear like a big headdress or something, so they have to see these ugly faces answering these questions. No,
but it's been a good year. I'm very appreciative of all the support. You guys coming back week in and week out, commenting on videos, liking videos, and just continuing to be there. So it's been cool to watch this thing grow, and I'm grateful for that.
No, 1,000%. We closed 5 loans today for one borrower who came and found us through YouTube. He had a very unique situation, had kind of got the runaround, couldn't get the answers he needed, and found us here. So we're very thankful for the audience you've built, for having us on here, and for these folks showing up and asking questions and reaching out and talking to us and allowing us to be a part of solving their issues, or just helping them put on a path to where they want to go.
No, absolutely. So once again, guys, I appreciate you being here. Happy New Year. We will see you in 2021. I think you'll see us for another second here.